Yeah, it's been a good quarter for us. I think a lot of the good work done over the last few years has manifested itself into the numbers. We've been helped by the tailwinds as well. The recovery in demand, both in the domestic and international markets, have been very strong, and that is reflected in the realizations that we've had. Going into quarter four, we had advised or guided that we will have a 6,000 to 7,000 rupee realization improvement in Q4 compared to Q3. I think we did better than that. And if I look at April and May, yes, prices have gone up thereafter as well. So both in the domestic market and in the international market. And what we've guided in the analyst call is that in this quarter, we will again see at least about 7,000 rupee realization improvement over the quarter four of last year.
Sure. What can we expect then, Mr. Narendran, from the June quarter? While it's a clear assumption that pricing is going to be steady, could it really compensate for any effects of the second wave that it may have had on production and demand, if at all?
So there are 2-3 dimensions to keep in mind. One is the costs are also going up. So it's not just all the price increases will translate to the bottom line. There are some cost increases because a lot of costs have been going up. When iron ore price goes up, even though we have a lot of our own iron ore, but the royalty goes up and the government going up. And even a lot of consumable costs go up. So while the margins will be, it's not necessary that all the price realizations translate to the bottom line. The second part is on the demand side. So far it's been okay, but we're starting to see the impact of the treatment to the fabrication units, because now all liquid oxygen is being diverted for medical use, and that's having an impact on fabrication facilities, that's having an impact on the SME sector. Still early days, and I hope as oxygen situation improves, some of the liquid oxygen will be made available to industry. Otherwise, we do see some impact of that in downstream sectors. But the international prices are still strong, so we are not expecting any material impact on both the production and demand for this quarter.
While it's great business for you, the other angle of the same, pricing dynamic is auto industry, other steel consuming industries. They've been actually hitting the brakes because of the rise in input cost pressures for them. What sort of demand impact do you expect if these industries do actually halt production for a while to try and mitigate the rising input cost pressures?
So I think while the auto industry is seeing some slowing down because of the wave 2, but at a fundamental level, the demand has been strong for most of the consuming industries. That's one point I want to make. The second point I want to make is the prices in India are not in isolation. In fact, I dare say that the steel prices in India are probably the lowest in the world at this point in time, because if you look at international prices, they are much higher than the prices in the domestic markets. So any of our consumers who are exporting their products are actually at a significant advantage, because their competitors in other countries are buying steel at higher prices. So if you look at the US, the steel price is $1,500 for hot rolled coils. If you look at Europe, the steel price is €1,000 for hot rolled coils. And if you look at Southeast Asia, the steel price is close to $1,000 for hot rolled coils. So when you look at it from that perspective, I think the consumers of steel in India are still at a significant advantage compared to their peers.
Sure. You've clearly put the focus back on, growth projects as well as CAPEX. Help us understand what's the CAPEX that you've outlined for the India projects?
So I think this year we've said that we'll probably be spending about 7,500 crores in the projects in India, both on Kalinganagar expansion, which is going to be a chunk of this capital allocation, and some amounts coming from the raw material expansion to support the expansion in the steel production that we're planning for. So we will focus on completing the Kalinganagar project. We had started it 2 years back, paused it a bit last year, and we've got it started again. And we hope to complete some parts of it, which is the pellet plant and the cold rolling mill, in the next 12 to 18 months. And in the next 24 to 28 months, get the rest of the plants going, so that the 5 million ton expansion will be completed by 5 years.
Sure. Further to that, you also mentioned that you're going to be looking at inorganic growth opportunities as well. Any assets that you're eyeing, especially when it comes to long products?
Yeah. So for flat products, we will focus on organic growth because we have the opportunity to expand in Kalinganagar, in Angul, which is a Bhushan plant, and in Jamshedpur. For long products, we will certainly look at inorganic growth opportunities. I think the government has announced that Nilachal Ispat and RINL, are in their roadmap for divestment. So we will certainly be pursuing those options as and when the process starts or process continues.
The one thing that one has observed is, especially in the quarter gone by and the commentary thereafter, that the board has changed the stance on the EU business. Its financials are once again being prepared on a going concern basis. However, I wanted to understand from you and gauge how vulnerable does this business continue to be in the steel cycle, and what is it that you're doing at your end to try and prop up the business?
There are two things which are happening. Of course, had tried to consolidate the European steel industry. A couple of efforts did work out for multiple reasons. But having said that, that did not stop us from continuing to focus on the transformation work in Europe. And a lot of great work has been done over the years. And we are also in the process of splitting the business, the Dutch business and the UK business, so that we have a sharper focus. The strategies for long term are different in each of those businesses. The operational challenges are different. By splitting them, we are able to focus on them in a more sharper way than when they were one integrated. That is one point. The second point is, as we've grown our India business, the balance sheet and Tata Steel financials are structurally in a stronger place. So 10 years back, the India business was 30% of our revenue. Today, the India business is 70% of our revenue. So we are much better positioned to deal with down cycles because of the fact that the India business has always been cash positive and one of the most profitable businesses in the world, even in the down cycle. And the Europe business is now only 30% of our overall portfolio. And the European business has also taken out a lot of costs and are in a better position to deal with down cycles than before. And over the last year and even this year and hopefully going forward, I think the business should be able to support itself. We said that 2 years back that we want these businesses to be cash positive. And I think they've demonstrated that they can stand on their own. So I don't think they will be as much of a drain on the cash out of India as they've been in the past. And that makes Tata Steel in a much better position than before.
Sure. The other thing, Mr. Narendran, was that there was a high carbon credit provision for the EU business. What's the status on carbon credits based on the current production and allowances which has been granted?
Yeah. So there are two dimensions to it. One is on an ongoing basis, we get allowances from the governments, and there's a gap between the allowances that we get and our carbon obligations in some sense of the term, if I can call it that. And that is typically priced into the cost. Okay, so that may be anything from 10 to 15 euros a ton, which is built into the cost. And going forward, and we've already done that, we're starting to say that there will be a carbon surcharge, which will get adjusted depending on the carbon price in Europe. Because the carbon price in Europe is fluctuating very dramatically. It's now close to 50 euros. And so that translates into a 10, 12 euro per ton cost on us. And that is something that we are passing on to our customers as a surcharge, and they've accepted that. So that's one part of it. The provisions that were made last year was more of a one-off. That was because last year in quarter one, when India business was also struggling because of the lockdowns, we were obviously very focused on cash, and we had asked the European business to unwind the positions that they had and to sell the carbon allowance that they had. They needed cash so that they could support themselves and buy it back later when they had cash to buy the carbon credits back. So in the process, we had to make some provisions because during that time, the carbon cost went up. And those are the provisions which are in the books in the last 12 months, but those are one-off, and that was more translating carbon we had into cash during that time. Going forward, as I explained, it's more evenly balanced and we will not have this.
Sure. Also wanted to understand how exactly do the carbon policies and Brexit overall impact the EU business? I know we've talked about Brexit often in the past, but just wanted to gauge where things stand as of now.
So as of now, Brexit has not had any material impact on our business, and the policies are continuing from as it was when part of the EU. So I think going forward, we look forward to the policies in the UK evolving, and we expect and hope that they will continue to be more and more industry friendly and encourage local industry. And we are a very important part of the steel value chain in the UK. And hence we believe that the government will be supportive of us. Right. In Europe in general, as you can see, they lead the world in terms of regulation on climate change issues, and even in terms of the exchange trade mechanisms that they have for carbon. So there is a carbon pricing which is inbuilt because of the fact that you can trade your carbon credits. But what the EU is doing, because they're very conscious that they don't want to decarbonize, they don't want to deindustrialize as they decarbonize, right? So they want to make sure that the industry is secure, and hence they're looking at a carbon border adjustment mechanism, which is, I think, being taken to the EU Parliament over the next few months. And that will make sure that the EU industry, which is paying a carbon cost, is not disadvantaged by cheap imports from countries who don't pay the carbon cost. So in a way, you are making sure that there's a level playing field. And so we believe that going forward, while the carbon cost will be there in Europe, there will also be some sort of a protection for industry so that they're not disadvantaged unfairly.
Sure. What's the status on the Southeast Asia business? Is it no longer for sale?
We had again looked at the Southeast Asian business and felt that if there was somebody interested in it who had a larger ambition for Southeast Asia, we are happy to pass on the business. At that time, we were also focused on deleveraging and said that anything which comes our way is helpful, right? But having said that, the Southeast Asia business has never been cash negative. It has always stood for itself. It has been able to stand on its own. And so the kind of pressure that we had in Europe was not there in Southeast Asia. It's just that when we found somebody who had a greater ambition than we had for Southeast Asia, we said if that's the right parent for the Southeast Asian business to be it. So as things stand, again, there were two interested parties, neither worked. And since the business is doing quite well and has always been able to stand on its own, we are in no hurry to take a call on that. The business can continue to take care of itself. And so we said it's not for sale. And we've integrated it back into the business, and we will run it like we've run it for the last 15 years.
Sure. For FY22, where is it that you aim to be on your volumes as well as product mix?
So in terms of volume, what we've guided is the India volumes will be about 1 million tons more than last year in terms of production and obviously sales. And if I look at the European business also, we've guided that we'll be 1 million tons more this year than we were last year. So that's the volume side. In terms of mix, obviously the revival of the auto sector both in Europe and in India is positive for us. We have almost 50% share of business with the auto sector in India. So the revival of the auto sector is accretive for us from a value point of view. If you look at Europe, again, we have a strong auto footprint. So the revival of the auto business there is also positive. Third point is obviously we will be selling more in the domestic market this year than last year. Normally that is value accretive because the domestic prices are higher than the international prices. Just now international prices are higher. So we are rebalancing that part of our mix. But for multiple reasons, we believe we are in a better position from a mix point of view this year than we were last year.
And what happens to your margin as well as debt picture for FY22?
So again, we've guided that we continue to be focused on deleverage, that we will have a minimum reduction deleveraging goal of $1 billion. If we can do more like we did this year, we will do that. Margins, obviously, as things stand, at least as far as Q1 and Q2 is concerned, we think the margins will be better than it was last year. But second half of the year depends on how the wave 2 plays out and whether there is a wave 3 in India or elsewhere.
I have to ask you, Mr. Narendran, your shareholders are a very happy lot. In just the last 1 year, your stock has appreciated 368%, and 6-month appreciation of 163%. Even in the last 1 month, it's a 40% price appreciation that we've seen in the Tata Steel stock. What is it that you would like to tell them, given how fabulous the run for them has been in the last 1 year?
You know, the interesting thing about a lot of the Tata Steel shareholders are they're multi-generational. You know, many of them, and we have more than 1 million shareholders, and many of them have been holding the shares for a long time.
Yeah.
So it feels good that they get good returns. I think they have trusted us, they've had faith in us, and it's time for us to repay that faith.
But is the best yet to come, or would you say in the last 1 year the best is behind us?
I'd like to believe that the best is yet to come.
Okay, great. On that note, Mr. Narendran, pleasure having you on the show, and thank you so much for taking the time and speaking with us today at ET Now. Stay safe.
Thank you.